Good. Should have started. Excellent. So hello, everybody. Uh, Today we have the pleasure of having our very first webinar series for alumni. And we have a huge pleasure of having Richard Ogdon and Vahan Kalayjian. They're going to be with us today talking about the global financial sector, uh, speaking about the challenges and opportunities within this field. Uh, Most importantly, the alumni tune has prepared this for you so that we can learn and exchange with top people in the field. Uh, Today, for those that don't know about the alumni tune, I would like to briefly share a bit of what we've been able to do so far. This initiative, or the alumni tune, was born out of the 10th anniversary, which happened in Dilijan, where last October we got together and thought about, okay, how can we as alumni give back to the school and help in multiple ways. Up to this date, we have over 60 people, the alumni that are joining us in various ways. We've already been able to initiate some projects. Notably, some of you participated in a launch party where we had some games. We talked about various aspects of the school, the cafeteria, the dining, the hospital, and we were able to reminisce a bit about all that. We also created the alumni map, where we are able to map where the alumni are, given that they put information about where they're currently located. We also have alumni mentors who are also sharing with current students of UWC Dilijan their knowledge about essay writing, schools in general. I'm going to be sharing the links to these initiatives, so you can join us, and it's a great opportunity for someone that's trying to start something new. Since we are so new, you can always start something. Okay, so this is an open invitation for everyone. Okay, without further ado, I'm really speaking a lot, so I'm going to introduce our two speakers. So first, so again, we're talking about the global financial system challenges and opportunities. Vahan Kalayjian is the chief financial officer of UWC Dilijan, where he leads the college's budgeting, financial reporting, and strategic planning efforts. In addition to his role at UWC Dilijan, he serves as vice president at Excelsa, uh, a real estate private equity firm, where he is responsible for multifamily asset management, fund structuring, and financial modeling. Vahan was instrumental in the launch of Excelsa's first real estate fund, developing financial models and budgets, forecasting cash flows, and contributing to investor and management reporting. With over a decade of international finance experience, he holds a BA in finance and has also passed CFA levels 1 and 2. Our second speaker, Richard Ogdon, has more than 35 years of experience in the financial sector, with senior positions in investment banking, private equity, and fintech, with a focus on the development of the Russian and CIS financial markets. Richard began his career at UBS Warburg in 1987, where he worked for 13 years until 2000, starting the bank's business in Russia in 92 and establishing the bank's Moscow office in 94. In the 2000s, Richard worked in Moscow at Russia's leading independent investment bank, Troika Dialog, as head of investment banking between 2003 and 2005, and then as chief risk and capital officer between 2006 and 2011. From 2012 to 18, Richard served as an independent non-executive director and board audit committee chair at the UK FCA regulated Russian securities brokerage Sova, previously Otkriti Capital. Richard has worked in education at his alma mater, Eton College, in 2013, and at the Cambridge Careers Research Advisory Center between 2000 and 2003, helping both organizations raise money for new educational projects. Richard is also a member of the supervisory board of the Russian Independent Directors Association and International Goodwill Ambassador of the Aurora Forum, a global humanitarian initiative. Needless to say, we're talking to the top of the field. So now I leave the room, the floor for you guys. I'm just going to keep track of the time and questions. Please, for those that are also joining, pose your questions, ask your questions in the chat. And here we have a great opportunity to ask important questions to these wonderful speakers. Thank you.
Marcos, thank you very much indeed for that. Really delighted to be here, and congratulations to you, Dalia, and the rest of the group on getting the alumni tune off the ground. It's certainly something very dear to my heart. One thing I would add to your excellent introduction is that I'm also a governor of UWC Kalayjian and head of the Finance and Audit Committee. So that's my direct connection with UWCD, in addition to the other points that you've mentioned. So the global financial system, I think we need to start by saying a few words about how we got here, without it being a history lesson, but given that I worked for 37 years in the system and saw it all from a bird's eye view, I think we should look a little bit at some history before focusing on the present and then the future. But don't worry, I'm not going to talk about tulips in Holland in the 17th century or coffee shops and exchanging goods in the city of London in the 18th century. I think the right place to start is actually at the end of World War II, because a lot of the decisions that were made then actually impacted and are still relevant today. And why is that? Well, because at the end of the last war, basically, you had a situation where the US had 70% of the gold reserves of the world and was the only currency linked to the gold standard. Basically, everyone else was bust, to put it simply. The US had two choices. They could either just let people get on with it, or, which is what they did do, is they participated in the post-war recovery, not just of the Allies, but also actually of Germany and Japan as well. And that was instigated by the then US Secretary of State, George Marshall. It's called the Marshall Plan. And what they did was they financed, through aid and loans, the building of new factories and the reindustrialization of the war-torn economies. And it became a virtuous circle. By doing that, particularly Germany and Japan, but already all the countries exported back to America, who became like the world's primary shopper, primary buyer, and they earned dollars and built up their reserves and capacity. So that's how this cycle of exports from countries and the United States using their position to buy the goods really started. And at the same time, at a place called Bretton Woods, two financial institutions were established. One was called the IMF, which was basically, their job was to make sure that no one ran out of money. And the other was called the World Bank, which was the world's financial builder. And the IMF went around countries administering emergency financing, like a money doctor. And the World Bank financed reconstruction, mainly in those days, roads, railways, bridges, etc. And the dollar was the currency, and other currencies pegged themselves to it. So that's how things really started. And as accumulation of wealth outside America began, then you had capital markets beginning as well, including most famously the Eurobond market, which actually started as a way for both companies and individuals to invest their hard currency earnings in financial instruments, but outside America. And the first Eurobond was issued by the Italian roadway ministry. It's called Autostrada. It's $15 million in 1964. And it was actually organized by my first employer, S.G. Warburg, at the time. So that's how things started. And also in the 50s, the European Union, what became the European Union in terms of trading blocs, started with the coal and steel community. And really, the 50s and 60s became a pretty good time for the post-war economies as a result of that. And it wouldn't be an exaggeration to say that the renaissance of West German and Japanese industry was considered an economic miracle. But then in the 70s, sort of the wheels came off, mainly because the Vietnam War cost America so much money, and it really hit the dollar. And actually, in the end, the dollar was taken off the gold peg. It was the only currency that was linked to gold. By the way, what that means is if you have a currency linked to gold, you can actually redeem that currency for dollars. That was really the case until 1971. But it was taken off, and then you had an oil crisis. Basically, the Middle Eastern nations in the 70s. I remember this as a young child. Basically, oil went up 4 times during that time. They embargoed oil as a protest for what essentially around the U.S. connection with Israel. So the 70s were a bad time. There was a lot of recession, high inflation, strong unionization, low growth. Britain had electricity power cuts. We had a 3-day week. We had the IMF coming to visit. It was no better in America. Interest rates were routinely 20% at the time. And things were looking fairly bleak. But in the 80s, that cycle was broken. It was broken primarily by the perhaps ultra-free market economic policy of Ronald Reagan and Margaret Thatcher, who basically insisted on competitiveness. And they started on their home base. They actually said, if our industries are not competitive, then we're going to close them down. And that's what they did. And actually, I remember visiting closed down General Motors factories in America, huge factories. And in England, obviously, the coal mines were closed with tremendous social consequences. But they were uncompromising in the need to deregulate, to create, to remove barriers to trade, to de-unionize. And what that meant in the financial industry was that banks started to become more international. They started to become global, and the stock markets became much more substantial. The growth in capital markets as a result of these changes. And so you had basically a boom in the stock market, which was sort of characterized or satirized, at least, in things like Wall Street with Michael Douglas, if you remember, and the bonfire of the vanities and all that. That was as a result of those policies. It's probably worth mentioning that the role of sovereign finance at this time as well, because export credit agencies were established, government-owned in many countries, to basically support exporters. and that was a very important instrument. And currency controls were abolished. So, I mean, I remember in my passport when I went abroad, I used to have to put down how many pounds I actually had when I was leaving the country. That until the 80s. So that's where we were at the end of the 80s. And then in the 90s, the trends continued, particularly in the EU with the establishment of the political and monetary union, ending up with the introduction of the euro, but also the North American Free Trade Association, the ASEAN Association. So a lot of global trade agreements were reached. It was an exciting time. The Berlin Wall, of course, had fallen in '89, which had opened up a whole bunch of new markets that required financing, including obviously the former Soviet Union and Eastern Europe. South Africa, it was the same, obviously, with the freedom of Nelson Mandela becoming their president. And of course, we had the start of the internet. So these were boom times. Banks became bigger, they became more global, they needed more capital, and the wave of consolidation. Being local champion wasn't enough. You needed to be cross-border. You needed to have expertise in areas you previously didn't. And I saw this myself. I mean, SG Warburg was Europe's #1 investment bank in 1995. But it became not big enough. It became irrelevant for the needs of the new decade and was bought by UBS. And in fact, UBS and Deutsche Bank became the only banks really at that time that could compete with the US, by which I mean really Citigroup, JP Morgan, and then the bulge bracket investment banks. So the end of the millennium was pretty optimistic. And then in the 2000s, I think that it's fair to say the trends continued, but the most important was the introduction of China to the World Trade Organization. And this really created, again, that virtuous circle that I talked about before after the Marshall Plan. So instead of, if you like, America buying the goods from Germany, Japan, Taiwan, by the way, everything was made in Taiwan in the 1980s and 1990s. Now it was China's turn. And this was a huge, huge development. It can't really be overstated. And as a result, China built up enormous US dollar reserves. And the Americans were happy to go along with it at the time because it became it was a symbiotic relationship. Let me put it that way. And of course, if you know the phrase, if you owe someone $10,000 and you can't pay them back, you've got the problem. But if you owe them $10 million and you can't pay them back, or you may not be able to, then actually they've got the problem. So it's complicated when you have countries like Japan and China that hold such large reserves in that area. 2001, of course, was the time when Jim O'Neill of Goldman Sachs established the coin. He coined the acronym BRIC for the first time. And it was clear that the emerging markets, initially of Brazil, Russia, India, and China, were where future growth and future opportunities lay. And this was clear from the beginning of 2001. The role of technology, of course, ballooned in this period. It started, as you know, at the end of the 1995 onwards, but the role of technology in capital markets, and also the way in which the mobile phone and the smartphone essentially broadened access to financial instruments, was another major tipping point in this time. Probably worth mentioning a couple of words on sovereign wealth funds. I talked about export credit agencies and their role in the 80s and 90s to help exporters. In the 2000s, sovereign wealth funds developed. Most of them were to invest the reserves of countries that had accumulated very large amounts of foreign exchange, mainly dollars again, because they were selling oil, and then redeploying them and reinvesting them outside that industry. I myself joined the Russia's sovereign wealth fund in 2011. So I got quite a bird's eye view on how sovereign wealth funds actually works and develops, both as a way of attracting capital into their country and a way of exporting their capital to other countries as well. So that's a little bit of a brief overview. I think the important thing is to say that there was a lot of bumps in the road. So I'm going to very quickly list them. Bumps in the road, they really were. So the first one actually is my first week at work. It was in 1987, which was the Black Monday, the stock market crash of the US, which was caused actually by Japanese real estate collapsing. And it was the first time really that contagion came into the system. People couldn't understand how it was that collapsing Japanese real estate caused a global stock market meltdown, but it did, and the situation was exacerbated by electronic trading, which had just started. So when the market went down a certain amount, then automatically people would start selling through program trading, and it then became a vicious circle downwards. 10 years later, what started as a currency crisis in Thailand ended spectacularly with a currency default in Russia in August 98. And here, the reason was really hot money coming in to countries and then coming out. So it was all very well and good to establish liberal no currency controls. So money could come in, money could invest in the country, but of course it could come out as equally quickly. And that's what happened really in 97. In 2001, we had the dot-com bust, of course, and 9/11, which was really more of a bubble bursting, a sort of tulip moment, really, of the 21st century. Lehman crisis in 2008, probably now getting nearer to your memory span here. This was really caused by an epidemic of mortgage defaults that on loans that many people should never have actually taken out. But the financial system needed feeding, and it raised a whole load of questions about responsible finance and should borrowers have been encouraged to take those loans. And it was the same for sovereigns too, by the way, with the Euro crisis in 2011 in Greece. I think their debt to GDP ratio at the time they were defaulted was about 300%. Then we had COVID in 2020, and of course we had the energy shock coming from the Russia-Ukraine conflict of 2022. Now, each of these crises were different, but there are a couple of things to say. One is in terms of the policy response in regulation, they tended to there tended to be a theme around more capital, stricter risk controls, stricter controls on compensation, and also separating business units. So, for example, a commercial bank would be forced to have a completely different ring fence their retail business, for example, from their investment bank. But I'll tell you guys a secret. The real policy response for almost all of these crises was that the authorities cheated. They bought their way out of the problem. What I would call financial alchemy. What do I mean by that? Well, Alan Greenspan and his put was about reducing interest rates to zero. Quantitative easing after Lehman was buying all the bonds so that the price didn't go down. And fiscal stimulus in terms of literally printing money. In the case of COVID, printing money to send checks to people's houses. I think it was about a third of the US money supply was printed during the COVID period, and so on. Bailouts. In Britain, we pay people to stay at home. All of this was financed by governments using fiat money. Now, remember, none of the no money is linked to the gold standard anymore. America was the last in 71. And it's really amazing, actually, when you think about it, because it actually made no difference to the value of these currencies. The US dollar, the euro, the British pound, the Swiss franc, the yen, between 2008 and 2020, despite this, was still valuable. It didn't make any difference fundamentally. And it's one of the great mysteries, frankly. And it's obviously very unfair, because if many other countries did that, then it would absolutely kill their currency. But that's really what happened. Now, a couple of words on, I think, on interest rates and inflation, because it sounds boring, but it's incredibly important, the link between interest rates and inflation. Inflation, obviously, is the big enemy of the consumer and of society, because if the value of your pound and dollar, or your ruble, or your Deutschmark, or your Reichsmark in the 1920s goes down, you can't buy anything, then it creates big problems for society. And the way that banks regulated this, they tried to, very simply, was that if inflation was high, then you had to raise interest rates to take money out of the system and reduce people's buying power. And that would then reduce prices. Paul Volcker, who was Reagan's famous central bank governor, did this famously, and he managed to get US interest rates down from 20% to, normal levels, at that time, normal levels of 9 to 10% in the 80s. And the other way around. So if interest rates were low, it meant that your inflation was under control, and it produced more money in the system, which then enabled economies to grow. And generally, people will say that if you need inflation at 2, interest rates at 3, and then growth 4+, providing you don't disrupt that 2 and 3. Something around those lines is considered optimal. But the problem is when you break the link, and that's what's happened. Then suddenly you're back with a blank sheet of paper. So what happened in 2008 after Lehman was that they reduced rates to 0, but inflation was also at 0. And it wasn't like for 1 year; it was at 0 for 12 years, and inflation was and interest rates were at 0 for 12 years. People needed to pay banks to put their cash on deposits, so-called negative interest rates. So this was completely unprecedented. And then it took another external shock in terms of COVID, and of course the energy crisis, with the cutoff of Russian supplies to most of the world, to reinstate that link between inflation and interest rates. So inflation moved up to 11% in 2022, which is sort of the highest I can remember this century. I don't know whether it's been higher in developed markets. Obviously, in Russia, for sure, it was, and in emerging markets. It's a very important link in finance. It's boring, but it's crucial. And I think what happened in 2021 is actually that the central bankers were out of practice with interest rates and inflation, because they just hadn't had to deal with it for 12 years. So they were late. So when inflation started, actually, they were late. And it created a problem which needn't necessarily have been quite so bad. So I think that's a sort of quick run through of sort of how we got to where we are today. And I think, we can talk about responsible finance perhaps a little later, because I think, there's very much a theme, particularly in the way these crises happened, that that finance is responsible not just in terms of the use of the proceeds, but also the relationship between investor and borrower. So is the investor the right investor to make that choice? And is the borrower really fit for purpose to take on that load? And I think that's something that was fundamentally was behind the Lehman and the Euro crisis. So where we are today, well, guess what? The US is still dominant. Yep, 30 trillion of GDP, China 20. And actually, 50% approximately of all US dollars, cash and non-cash, are held outside America. I mean, there's no other currency close to that. No other in a million years. And another quite interesting statistic I came across is that outside China, 99% of credit and debit card transactions are made by US card issuers. So obviously in China, 100% are made by UnionPay, but outside, it's the opposite. So that's where we are right now. And I think I would make three main points about where we are. The first is we're seeing that there are some big challenges to the status quo. I mean, it's clear that the institutions that I talked about earlier that were established after the Second World War, I mean, they're clearly no longer fit for purpose. It's clearly crazy to have a G7 that doesn't include, for example, India and China. But it's also crazy to have a group of countries under the BRICS label that excludes industrialized nations. And at the moment, we have a situation where one is not speaking to other, which cannot be right. The second is really the challenge to fiat money. I mean, I said it's like alchemy, which it is. And obviously the growth of crypto and digital currencies and stable coin perhaps is a less volatile and more secure form of crypto are examples of that. But it's still very much early days. I mean, you'd look at Bitcoin, the amount of Bitcoin in circulation globally is about $3 trillion dollars, which is about the same as Apple. It's about the market capitalization of one company on the US stock market. So there's still a long way to go in terms of alternatives to fiat currency, but there's a lot of work obviously going on in that area. The other challenge, I think, is to traditional banks, and we've seen an explosion of fintech companies come up and do really valuable work in promoting financial inclusion, reducing transaction costs, improving the way that money can be sent across the world, and just generally taking some of the mythology out of the big bank system. So that's a big area, the big challenges to the status quo. I think the other one is technology dominance. Technology used to just be part of the plumbing in financial services. It's now a big threat as well and needs to be managed properly. So you have, it accelerates the cycles and the news flow. And that can be quite existential if you're a bank like Silicon Valley Bank, where everyone was using their mobile phone to tell everyone else to take out their deposits within 15 minutes. But it increases volatility as well, and it accelerates cycles. I'm a board member of a commercial bank, and for me, the number one risk now is not, can our borrowers repay their loans, or do we have enough liquidity? The number one risk is, are we sufficiently robust in our IT systems? What do we do if we have a hack? What happens if someone issues ransomware against us? This is a huge area now for the financial system, which needs to be clearly managed. And then, of course, finally, the system's unfair. I mean, come on. I mean, think of all that money that was printed over the last 20 years. Huge amounts. It doesn't seem to really have ended up in always the right hands. We have a cost of living crisis across the globe. We still have enormous problems with people making ends meet. There's no accountability for the past, what happened with some of these crashes and stuff. That's really where I would sum up where we are now. If we look at the challenges and the opportunities, the challenges, it's quite a long list, and I'm not going to go through them in detail, but we still need to pay for the past. The financial system needs to do that, and it needs to pay for the future in terms of pension provision, etc. Most importantly, also, it needs to pay for climate transition. Tax havens still exist. So there's a lot of money that hasn't quite made it into the system to address these issues. If we go to climate, which I'm sure is an area close to all of our hearts, I remember in 2019, I was attending a meeting of sovereign wealth funds. I guess the main sovereign wealth funds of the world, and we received a delegation from the UN Climate Change Commission, and also Adair Turner, who was head of the energy transition. I looked out his presentation yesterday to remind myself what he said, and basically he said, look, for the next 30 years, we need to spend just over $1 trillion a year on converting energy from carbon to non-carbon and to get to net zero. And he was talking to the world's biggest investors in the room. He said, this is not much in the overall scheme of things. It's less than 1% of GDP. It's 2.5% of global savings. It can be done if there's a will. I think that the real message, the real message in terms of positive rather than negative, is that there is enough money in the world to solve the issues that we face. There definitely is. And you can read every day, there's some stuff about the latest billionaires and all these people flying to Mars and so on, but also the amount of institutional investment, assets under management. There is enough to solve these problems. The key is to find the political will to allocate them in a way that solves these issues. And at the moment, I have to say that we seem to be going backward. So if I look about what we were doing at the end of the Second World War, nations helped each other regenerate and develop so significantly. We've sort of gone backward at the moment, and investors on the whole are quite indifferent to these issues. They're not all. The Norwegian sovereign wealth fund, which luckily is the largest, actually it's the largest in the world, is incredibly active in terms of responsible finance, responsible investment. And I would encourage anyone to look at what they do. I think it's a pretty good case study of what should happen in the future. And of course, there are a lot of rich people in the world. But unfortunately, not all of them are like Mr. Ruben Vardanyan. They don't have the vision and the breadth of to use their wealth responsibly and finance projects like the one of the school that you all went to. So I think that as UWC alumni, you guys are uniquely positioned, given the values of the UWC movement and your ability to listen to other people in a world where the financial institutions are now meeting in corners, where you've got the BRICS meeting in one corner, you've got the G7 meeting in another, and we all know they should be meeting together. Otherwise, no progress is going to be made. I think that UWC values, and as alumni, your particular DNA in this area, you could make a uniquely valuable contribution here, because for sure the system's going to change much more quickly and more dramatically than it did in my lifetime. But I think that you have a great opportunity to shape it, either a career in finance or outside. If you have a career outside finance, finance will still be a very important part of your life. And I would encourage you all to use your voice, use your fantastic education, your international experience to help people reconnect, and let's get that back on track. So I think probably said enough, actually. Vahan, why didn't you mention the case study of Lebanon, which I know is close to your heart, about responsible finance? Because I think that there are two levels of responsible finance. One is, as I say, if you like, the contract between the giver and the receiver of money, and the other is, of course, about how it's used as a way to improve governance, environmental and social concerns.
Yeah, of course. So, I mean, for years in Lebanon, years and years, basically money was flowing. US dollars were flowing into the country mainly through remittances due to high interest rates at the commercial banks. And so the government was operating, again, years over years over years on a deficit. So there was a deficit. And so the central bank, through commercial banks, were funding this deficit. And so at some point, what happened is there was a doubt about the sustainability of the banking sector. And so panic spread, and automatically people starting asking for their deposits. And obviously that created a vacuum. And eventually there was a default in 2020. It was the first time the Lebanese government defaulted on their sovereign debt. So obviously what happened here is IMF stepped in to try to help, but you know how the IMF works. They wanted reforms. They wanted, they had conditions for bailing out the government in a way. Unfortunately, due to the corruption, and which was causing the deficit in the first place, there was no political will to accept these reforms. And so, the system remained in limbo. It never was able, like the Lebanese banking sector was never, restarted in a way, in a healthy way. So this is what happened in Lebanon. And so we're still in the situation, like many depositors have their monies locked. It's just they can see the balance on their phones, but they can't access their money. So this is what happened in a few sentences.
Yeah. It's a big responsibility. And I remember when I started my work in Russia, I was SG Warburg. We had this group which had a specialization in advising sovereign governments that were unable to pay their debts externally. And when Russia, or when the Soviet Union defaulted on their debts, we were invited to come to Moscow and help them directly, not through a foreign aid program, but directly to negotiate an outcome with what was called the Paris Club of Creditors. Do you remember I mentioned export credit agencies? Well, Russia had loans outstanding to all the export credit agencies in an amount of about $70 billion. And we were involved for 7 years in coming to a solution to that issue. And at that time, there was so much goodwill and support towards giving Russia a helping hand in the transition that the rescheduling terms that we achieved, which were finalized in 1996, just before we organized Russia's first Eurobond, they were actually more favorable than any other nation had ever been given through the Paris Club, including sub-Saharan African countries. So the link between sovereigns and money is also very important, and how it can influence both positively and negatively. In that case, positively, outcomes. But I see we've got two excellent questions from our guests. So first of all, from Annie, to talk about digital assets, where do you think they're heading, and how can regulation keep up to enable innovation while assuring financial safety? And of course, I've mentioned the big risks of cyber and IT. Vahan, why didn't you have a shot at that one in terms of digital assets? What's your take on that? And the regulators are always going to be a step behind. Will they ever get in line, and will they ever really help make that happen?
I mean, where we're going with digital assets, I think it's going to become more common for countries to use digital assets, actually, digital currencies. It's going to keep on, increasing. Although right now, if we look at it, like as Richard, you mentioned, like the whole crypto market capitalization of the whole crypto industry is just a single company in the US stock market, which it matches Apple basically. But I think with time there will be exponential growth. We're heading there now. Obviously, it's due to its convenience. It's much more convenient, even for me, like transferring, transferring capital through like cryptos and digital assets. It happens in milliseconds at a much lower fee. So obviously, it's something tempting for people to use. That's why it will spread and grow exponentially. Now, will regulators ever catch up? I think they will eventually. But until they do, the risks that are in the digital world right now, in the crypto world and the digital currency world, are high. I'm not sure about the IT risk, but I think the risk of like fraud, corruption, money laundering, and all of these sort of stuff are there right now. So I'm not sure when will regulators be able to to control such risks, but I think it will take some time until they get creative towards and evolving. So the digital asset industry, it's evolving every day, day after day. So I think that's my take on this.
Okay, I mean, I'm going to add one thing to that. There was a big event last year in the crypto industries growing up, let me put it that way. And that was when BlackRock and Vanguard got permission finally from the US Securities Exchange to issue an ETF, an exchange traded fund based on crypto. And what that meant was that institutional investors and retail investors could buy an instrument that was issued by a highly credible organization for the first time. And a lot of the risks that were previously associated with crypto in terms of fraud, just lack of liquidity, and so on, were addressed by that. So that was a good start in moving crypto into mainstream. But the problem with crypto is it's just very volatile. And, you don't want money to be, you for money one day, 30 the next, and 100 the week after. So that issue with crypto hopefully will come of age, but that's the main problem that I would see as an investor. It's been partly addressed by this stable coin, where the US, Euro, and I think Switzerland have issued stable coins, which are actually backed by by exactly the same amount of the actual fiat currency, which is slightly ironic, really. So you have a stable coin of US dollars, but don't worry, it's backed by one fiat currency, which actually you're meant to be disrupting. But anyway, at least it takes away the volatility. It's very, very small beer at this stage. It's still only 250 billion, which is 1% of the US money supply. But that addresses that. Now, Jana has come up with an excellent question on BRICS, and I think we should all give a big shout out to Jana office with Satanik and others, and I know you know well, and has played a very important role in helping getting the alumni. Originally, Jana, is it was not a political grouping at all. It was just a Goldman Sachs economist saying, "Hey, these are with this acronym," and then people grabbed the acronym. For sure, South Africa is not comparable in terms of size with any of the other four that we just mentioned. Moreover, currency controls, although China does too, which also makes it different. But I think that I think the problem with the BRICS, and there's a very good article, by the way, that I was reading by Jim O'Neill, again, now in 2024. So 23 years after he coined, and he said, the BRICS grouping now doesn't make any sense. Okay, there is no economic cohesion behind the group. It's just like we're a club of people who are not the G7, and we're all together. Good for that, but actually extremely difficult to find any cohesion between, for example, Saudi Arabia and Brazil, or the UAE and Ethiopia. And the only real way to solve this issue is for BRICS countries and non-BRICS countries to start speaking and working together again, like they used to. And in fact, the G20 was a good example of that. The G20 actually played a very important role in saving the financial system after the Lehman crisis. And one of the reasons is it was so successful is that it included people from all walks of the world, and not just the industrialized nations or the non-industrialized or the global south or global north or whatever. Has to be done together. And again, I would go back to the great point about UWC and the UWC alumni is that you get this instinctively. This is what the education is all about. This is what the movement is all about, which is why you have such a great opportunity, I think, to play a role here, and an advantage, frankly, a career advantage in doing so as well. So what's the best sector in finance to work in if we want to have a positive impact? Vahan.
Well, I mean, that's a very interesting question, actually. I was just thinking there's an idea called effective altruism. And so it's kind of, you can be, why am I mentioning this? You can be working on Wall Street, making a lot of money, and then using this money to have a positive impact. That's one way of looking at it. You can be working for grassroots, non-for-profit, institutions like UWCD, smaller institutions, you can be doing a lot of stuff. So you have the option to be in corporate and having a positive impact, or you have the option to be in the non-for-profit, obviously having a more direct impact, if that makes sense. Anything you want to add to that, Richard?
Well, what I would add, for those that don't know me, I'm a musician as well as a banker, and I'm a great believer in mastering the basics and then moving specific niche. So like if you're a musician and you're a pianist, you want to master your Bach and Mozart, even if what you really like is Rachmaninoff, okay? And I think it's the same in finance. I think it's very important to get a few years under your belt, frankly, in a big and boring bank, to really understand the plumbing and the work, and then building on that, and of course it's good for the CV as well, is then to move into a specific area. It could be about policy, so you could go and work for the IMF. It could be about development banking with the EBRD or the World Bank. It could be about sustainability and impact investing, and there are a number of institutions around that. It could be absolutely working in finance, in education. So I think that's what I would add on that. I've been involved for 37 years and I wouldn't have missed a moment of it. I mean, I've been incredibly lucky. I remember in the Warburg dealing room in 1991. I was then a UK young banker. I was doing UK stuff. I was financing companies that made logistics lorries in the north of England. And then we saw on the Reuters screen one day that this guy Gorbachev had been held hostage in Foros in August 1991. And we understood that, the world had suddenly changed, like seismically. And it just came across the Reuters screen. And I remember that day forever. And because I studied Russian at university, of course, it gave me, and I'd learned the basics. You see, I'd done my 5 years in UK corporate finance. So there we are. I'm actually preaching what I actually practiced. And then I went off to work in Russia. You could say after 30 years with mixed results, but I would still wouldn't miss any of it for the world. And the work at Troika, and the way that Mr. Vahan established Troika and the principles of best Western practice within a very fast-moving, dynamic, and slightly cowboyish environment were great. Could the US ever increasing debt pose threats to the world? It can. It can if they decide to default. The unthinkable. Otherwise, no, it won't. I don't think so. I think that if the problem I have with where we are now is that usually for a country to solve their debt problem, the best way of doing it is to grow economically, and then you grow enough to actually start repaying your debt and balancing your books. That's the best. And that's what's happened in the past. And the only way to do that is through global trade. It's not by cutting everyone else off and actually penalizing the people that sell goods to you. If you're going to actually pay down your debt. But back to the point about, the guy that owes $10,000 and can't pay is in trouble, but if they own 10 million, then your bank's in trouble. I don't think it's going to get to that. I think that would be an absolute thing if the US repudiated on their debts, or they inflated their way out of them. Because that's the other way, of course, is that countries inflate their way out of debts. So they just create a very high inflationary environment, which is what happened in Latin America. I think Turkey are trying to do the same thing, frankly, now. So yes, but I think it's unlikely for the reasons that I've said.
But I'm sorry, Richard, what would happen? I mean, if they, if they increase inflation, keep on increasing inflation, how would that resolve the debt issue?
Well, it would reduce the nominal value of the debt.
I see. So it's
that's what would happen. So it's just, inflation. The problem with inflation is it reduces what's in the pocket of the victim of inflation. So if you own debt of the US, and then it reduces the value of what you have. If you earn your wages in the US, and suddenly inflation's at 20%, it means that you can buy 20% less tomorrow than you did today. So that's it's a big issue. It's a big issue, but I think it's that's the way that it will be solved. Not through inflation, sorry, through getting the world trade cycle back on track. And the other thing is about it's always something that really puzzles me. This idea that at the moment we live in a situation where governments are poor, but there are so many rich people. I mean, when I say rich, I mean, you know, how can it be that it's 3 or 4 people in America are each worth $300 billion, something like that? Ultimately, something has to give here. You can't have governments blowing up because they pay for a lot of societal support in the past, and then you've got these people who are just sort of off the planet, frankly, literally off the planet, because they actually want to spend their fortunes flying to Mars or somewhere rather than solving the problems of the world. So the first